Greetings class. In this video I'm going to go through the material we covered in class on Friday, January 21st. And these are exercises from part 1 and part 2. And I'm going to go through them here in this video to basically reinforce what we talked about in class. And as a beginning point, I want to talk about the accounting equation that we're working with, where we have assets equals liability plus equity. And we're going to expand that equation to include common stock for equity, that's an addition, minus dividends plus revenue minus expense. And the thing I want to keep in mind here are the normal balances. So for assets, the normal balance is a debit. Remember, it's on the left. So a debit will increase it, a credit will decrease it. For liabilities, they're the opposite of assets. So in this case, a debit will do the opposite. It'll decrease it while a credit will increase it. For common stock, it's going to be like a liability, where the debit will decrease it and the credit will increase it. And its opposite, the opposite of common stock, is dividends. Dividends are a subtraction from common stock. So for dividends, we have a debit as an increase. Sorry, I forgot to put the plus in there. A credit is a decrease. So common stock is just like a liability. Debits are decreases, credits are increases. Dividends, debits are increases, credits are decreases. Revenues are just like liabilities and stock, where a debit is a decrease and a credit is an increase. And finally, expenses, which are the opposite to revenue. Revenue and expenses are opposites. So we have a debit here is an increase and a credit here is a decrease. And remember what we talked about as remembering which accounts increase to the left. DEA is dividends, expenses, and assets. Those all increase to the left, meaning a debit is their normal balance. LOR are the accounts that increase with a credit, and their normal balance is a credit. So these accounts are common stock for owner's equity, revenue for the R, and liabilities for the L. So liabilities, common stock, and revenue all increase with a credit. So if you're going to the right, if you're using credits, you're increasing these accounts. If you use debits, you're increasing these. Keep in mind these normal balances, because we're going to work through this first scenario and we need to remember that. So in the first scenario we have in this first exercise we have 3 scenarios. And in the first one they tell us that Quarantine Company had $152,000 of accounts payable on September 30th and $132,500 on October 31st. Total purchases on credit during October were $281. Determine how much cash was paid on accounts payable during October. Well, to figure this out, we need to remember this is a liability account, and it increases with a credit and decreases with a debit. So that's where we start. We know the beginning balance is $152,000, so that's the normal balance. So we're going to put that on the credit side. That's at 9:30. And then it says that they had purchases on credit during October of $281. So we're adding to this account through these purchases. So we have $281,000 as a credit because we're increasing the account. And then it says we had an ending balance on September 30th of $132,500. So I need to move this up just a touch. $132,500. So if we're working this out, letter A, because these are all the same transaction on the same side of this liability account, we're going to start with beginning balance in liabilities plus the purchases of 281 to arrive at 433,000, which was the largest the balance could be before we made any payments. So we're going to subtract out the ending balance here. I'm sorry, I'm on the wrong one. The ending balance right here of 132.5 to figure out how much in payments we made. So 132.5. Subtract that out. So we add this, subtract the ending balance, and we get 300,500. And these are the payments that were made through that month. So we have a debit here of 305 because when they make payments, they're decreasing the liability. Okay? So for the first scenario, it's beginning balance plus purchases minus the ending balance to figure out how much they had to have in payments to get to that ending balance. Okay, for scenario B, it says on September 30th, Valerian had a $102,000 balance. This is a typo. It should be 102.5. If you use 102,000, the answer will not come out right. Trust me, I know that one. But anyway, 102.5 is the correct beginning balance. And that says during October, the company collected $102,890 from its credit customers. And on October 31st, the balance in accounts receivable was $89,000. We're going to fill that in as soon as we figure out what we're dealing with. First of all, accounts receivable is an asset that increases with a debit and decreases with a credit. So when we begin the balance on September 30th, that's the normal balance, and it's the side the plus is on. So we start with 102,500. So that is the 930 balance. Then it says the company collected 102,890 from its customers. And what that means is when customers pay you, their account balances go down. So we're going to put that on the minus side, 102,890. Okay? And the October 31st balance was 89,000, and that's always going to be on the normal balance side. So we have 89,000 here. All right. Letter B then is 89,000. We start with the ending balance, and we do that because we have both debits and credits. And so what we're going to do in order to figure out how much we had in sales, which is the question here, determine the amount of sales on credit that occurred in October. In order to figure that out, we have to figure out how large the balance was at one time. So we're going to start with the ending balance, add back the payments. So we add those back because these payments that customers made decrease the balances. We want to figure out where it was at its largest point, which is 102,890, and that total will be 191,890. And then we're going to subtract out the beginning balance to figure out, okay, how many payments would we have to have here in order to say 102.5 plus this minus that equals that. So 1025, and we get a payment, or not payment, we get sales, credit sales of 89,390. So because this is on both sides of the account, we're going to start at the ending balance, add back the payments that were made to figure out what the biggest balance we had, and then subtract out the beginning balance to figure out how many charges or how many sales on credit were made during the month to increase the balance. And that all comes because we know it's an asset, we know which side increases and which side decreases. Okay? And the last one here, letter C, says during October, Alameda had 102,500 of cash receipts and 103,150 of cash disbursements, and an ending balance on October 31st of 18,006. So once again, we're going to ask, okay, what kind of account is this? Well, it's an asset. The normal balance is a debit, and a decrease is a credit. So normal balance means plus. So when we're looking at this, we had 102.5 in cash receipts. That means that we collected 102,500 in cash. That means we increased the account. So that's going to go right here, 102.5. And then we had cash disbursements of 103,150. That's going to go on the credit side. So we decrease this account when we pay out cash. Our ending balance is 18,600. Now, because the normal balance here is what we end up with, this 18,600 is the normal balance. So we're going to take the 18,600 plus the payments that we made to figure out how big this account was at its largest, and then subtract out the cash we collected to find out how much we had to begin with. So letter C then is going to be 18,600 plus 103,150. That gives us 121,750. Then we subtract out the beginning balance, or the not beginning balance, but the cash receipts we had of 102,500. So the beginning balance had to be 19,250. So that goes in here, 19,250. Now, you can always test this and prove it by starting with the beginning balance, add whatever the side is that you have a plus on. So 102.5 plus 89,390 minus 102,890, and you'll come back to this. Likewise here, you had the beginning balance plus this minus this, you come back to this. And here it's the same thing. Add the beginning balance and the increases in the account, which are on the plus side, the normal balance, and subtract out the cash payments of 103,150, and you come back to the ending balance. Okay, so that's the first exercise that I wanted to cover with you. We have another one here in the second tab of this worksheet that's going to be a series of journal entries. And these worksheets are all located, the Excel worksheet is located in Chapter 2 module. I'll show you where it is right here. The worksheet for what we're doing right now is here, Accounting 201, Chapter 2 Exercises Part 1. And we're going to do the comprehensive exercise Part 2 next. But let's go back to this. So in this one, we have journal entries that we need to prepare for a new company called Pose for Pics. Madison Harris, the owner, invested $6,500 cash and $33,500 of photography equipment in exchange for common stock. So on August the 1st, we're going to record what Madison Harris gave to the company. So they increased cash. So remember, cash is an asset. It increases with a debit. We're going to always enter the debit first, like this, cash, and that's going to be $6,500. And then not only did the owner contribute cash, but also equipment worth $33,500. So we're going to add equipment here, which is an asset, and it'll be $33,500. And our credit then, and whatever you have in debits, you have to equal in credits. So the credit here will be to common stock, because the owner will receive stock in exchange for those contributions. All right. Then on August the 2nd, the company paid for $2,100 for an insurance policy covering the next 24 months. Now, if they say they paid this, that means they used cash. So that's an automatic assumption here. So for August the 2nd, we're going to record the purchase of an insurance policy that will cover 2 years as prepaid insurance. So we have prepaid insurance, $2,100, and the credit will be to cash because we paid for it in cash, $2,100. Okay. All right, the third transaction on August the 5th, the company purchased supplies for $880 cash. Now, prepaid insurance is an asset account, and it increases with a debit. Anytime you pay for something with cash, it's going to be a credit. So keep in mind what we were talking about. What increases an account is the normal balance. And if you know what kind of account you have, you'll know what the normal balance needs to be. Prepaid insurance is an asset. Supplies are also an asset. So we put in supplies with a debit because they're increasing, $880. And you're paying for it with cash, so you credit that here, $880. All right. That's August the 5th. Okay. And then on August the 20th, it says that the company received $33.31 in cash from taking photos for customers. So when we ask what happened, basically we earned income and we received cash. So cash is an asset. Therefore, it increases with a debit. So we're going to put it as a debit, cash. And that's going to be $3,331. There we go, 3331. And the other side of that, because it's money we earned, is going to be revenue. So we're going to put the credit and revenue. Now remember, both cash and revenue are increasing with this transaction. So that doesn't look exactly like what I want it to. Here, 33,331. So cash increases, revenue increases. All right. Here you have the asset supplies increasing and the asset cash decreasing. Here the asset prepaid insurance increases while cash decreases. On August the 31st, they paid $675 cash for August utilities. So we're going to date this August 31, and we're going to record the August utilities as an expense. So we say utilities, expense. That's $675. And then we're going to credit cash because we used cash to pay for it. $675. All right. So those are the journal entries. And again, remember the step we're using. Okay, what kind of account is it? Is it an asset? Is it a liability? Is it common stock? Is it dividend? Is it revenue? Or is it expenses? And all three of these come under the banner of equity. Okay, but it's going to be plus common stock minus dividend plus revenue minus expense. All right, so those are That is the second part of the exercise part 1. Okay. Now I'm going to go to the third item, which is a comprehensive problem. I need to add. Okay, so here is the comprehensive problem that we need to look at. So there's 2 parts. The first one is to use the accounts that they tell us here: cash, accounts receivable, supplies, equipment, all that. Do these journal entries, but at the same time we're going to be posting these entries into the general ledger T accounts. So we're going to start by creating these T accounts. So we have cash. We're going to have accounts receivable. I'm abbreviating it AR. Better make cash a little longer. And then we have supplies. And we have equipment. These are all assets. So abbreviate equipment. But these are all assets. So for all of these accounts, the debit side will increase them. So we'll have a debit increase, a credit decrease. And then we have accounts payable, which is a liability. I'm going to move this over just a bit. So we have another account, accounts payable. I abbreviate this AP. And this is going to be debit minus credit plus, meaning that's a normal balance is going to be a credit. Okay, and then we have common stock, dividends, services, revenue, and rent expense, all part of equity. So I'm going to start with common stock down here. And remember, owner's equity is just like liabilities. The credit is an increase, the debit is a decrease. Dividends are its opposite. So over here I'm going to put dividends, DIV, debit increase, credit decrease. And below this, I'm going to put the last 2 revenue accounts, which is revenue. The last 2 equity accounts, which is revenue. And remember, revenues like liabilities in common stock. With a debit, it decreases. With a credit, it increases. And then the last one is expenses, which are just like dividends. It's rent expense, not just any expenses, but rent expense, which is just like dividend. It increases with a debit, decreases with a credit. All right, so these are our general ledger T accounts that we're going to use. So before we do the posting, we're going to do the journal entries. So here it says that Casey Spade, owner, invested $100,750 cash in the company in exchange for common stock. So for letter A, we have cash as an asset and it's increasing. So we're going to debit cash. Well, the debit and the credit over here. This is the journal entry of $100,750. And we're going to increase common stock because the owner is going to take ownership of the company. So we'll say common stock is the credit. Now, for the purposes of a journal entry, the debit always comes first. And in this case, we're increasing cash, so the debit is an increase to cash. And the credit comes second. It's slightly indented to the right to show it's a credit, but it's common stock, and this credit here is 100,500, or 750, not 500. Okay, the second one says the company purchased supplies for $12.50 cash. All right, so the asset account supplies is increasing, so this is a debit to supplies for $12.50, and a credit to cash because we're spending cash, reducing the balance of $12.50. All right. Okay. And then, by the way, this is a typo in the problem. It says here the company purchased $10,500. It's actually $10,050 of equipment on credit. This is a typo in the original problem, so we need to keep that in mind or this won't work out. Okay. So for letter C, we're going to increase the asset equipment. So we're going to debit equipment for $10,050, and we're going to credit accounts payable because we're purchasing this on credit. So we bought it on credit, so the accounts payable $10,050. Okay. The next transaction, letter D, right here, the company received $15,000 cash for services provided to a customer. Okay, so we're receiving cash. That means it's increasing, so the debit is to cash. And it's for services that we provided, and the credit is to services revenue. And this is $15,000 as a debit and $15,000 as a credit. Okay, so that's letter D. On letter E, the company paid $10,050 cash to settle the payable for the equipment purchase. So what we're doing is, on letter E, we're decreasing the payable. So we're going to debit the payable, the liability, accounts payable, for $10,050. And we're going to credit cash because we're decreasing it by $10,050. All right. So that's the transactions through letter E. Then for letter F, the customer billed the customer for $2,700 in services provided. So what that means is, if we're billing, we didn't receive cash, but we have an account that they're going to pay on later. So we have accounts receivable, $2,700. It's an asset, so it increases with a debit, and so we're going to put the accounts receivable first and increase that because we sold them things on credit. The credit here, because we're selling services, is going to be services revenue, $2,700. Okay, and then we go back up here. We look at letter G. We paid $12.25 for the monthly rent. So we're going to go back down here. What kind of account are we increasing? Well, we're increasing the rent expense account. So we have a debit to rent expense because that's what increases that account. And it's going to be $12.25, I think. Let me check. Yeah, $12.25 or $11.25, or no, $12.25. Sorry. So it is $12.25, and the rent expense debit because we're increasing it, and the cash credit because we're paying for this with cash. All right, and then letter H. This transaction says that the company collected $11.25 in cash as a partial payment for the accounts receivable created in transaction F. All right, so we're going to collect money on these accounts receivables that we set up in F. So what that means is we're receiving cash. Cash is increasing, so we debit cash for $11.25, and we credit the accounts receivable because customers are paying down their balance, $1,125. Okay, the last transaction, letter I, the company paid a $10,000 cash dividend to the owner. So for letter I, we'll move down here and we'll say I. We're going to debit dividend because dividends are increasing for $10,000, and because we're using cash to pay for it, we're decreasing cash by $10,000. So it's a credit. So those are the journal entries. And when we come over here, next we're going to go through these accounts and post them into the general ledger. What I want to emphasize here is cross-referencing them with the letters here. So for cash, the first transaction is letter A. And in this one, we have a debit to cash for $100,750. We have a credit to common stock then for $100,750, which is right here. So we're putting both these numbers in the property account. For transaction B, we're debiting supplies. We're increasing them by $12.50. So for letter B, $12.50 on the debit side to supplies. And for letter B, a credit to cash for $12.50. So here you're going to put B, $12.50. All right. And then when you get to equipment, you're going to purchase it with credit. So you're going to debit credit or debit equipment for $10,050. So we come over to equipment. We're increasing it by $10,050. And then we're going to credit equipment, or not equipment, we're going to credit the payable for $10,050 for the equipment because we're buying this without cash. We're buying it on credit. So letter C goes as a credit to accounts payable because we're increasing liabilities, $10,050. $10,050. Okay. So then for letter D, we're going to increase cash for the services revenue that we receive. So we have $15,000 in cash we collect, and we're going to debit the cash for that. So that is letter D, 15,000 debit. And we're going to credit services revenue here with letter D for $15,000. Okay, that's letter D. Letter E, we're going to pay the accounts payable in its entirety with cash. So we're decreasing accounts payable and decreasing cash at the same time. So letter E, we're going to go to the accounts payable and debit it. Here's letter E, 10,050. And letter E, the credit will come from cash over here, 10,050. Okay. All right. And then letter F, we sold some stuff on account, services on account. So accounts receivable will increase because it's an asset, and services revenue will increase because it's revenue, and we're going to credit it. So we add to accounts receivable, letter F, 2,700. And over here, under revenue, letter F, a credit of 2,700. Okay. For letter G, we paid rent expense, so the expense account will increase. That is a debit, and we're using cash, so the cash account will decrease. So we go to the rent expense account here, G, and we say 1225 is a debit, and we go to cash with G, and the credit is 1225. All right. All right, letter H, they collected cash. That means the cash increased with a debit of 1125. So we'll go up to cash here. H, 1,125. And then we'll go down here to, well, not down here, we'll go over to accounts receivable. With letter H, it'll be the credit of 1,125. Okay, the last one we have is the dividend for letter I for 10,000. So we'll come over to the dividend account right here, reference it with letter I. This should have been letter A right here. Letter I here. That's 10,000 for the debit. The credit will come out of cash, which is what we have here in the journal entry. Credit from cash. So we'll go back up to cash. We'll go back up to cash. Go back up to cash. Anyway, the credit here is 10,000. Okay, so now what we will do, the procedure here, is to total both sides and take the difference between the two. Now, I'm just going to go through and give you the balances in these accounts because we did this in class. And basically, we don't have much room here to work with, so I'm just going to go through and give you the final balance. So when you total these up for cash right here, you get 1/6 on this side. You get 116, 875, I think. On this side, this is larger than this, and the balance will be on the debit side. It'll be 94,350. Okay. So this, I think, works out to be 22,425. Yeah, it does. 22,425. I was off a little bit. Anyway, so that's the balance here is 94,350. Okay, so in the receivable account, I'm going to erase this because I want to work with receivables. We're going to have a difference between the original debit increase of 2,700 and a decrease of 1125, meaning we have an ending balance here of 1,575 on the debit side. Because we paid this in full, there is no balance in accounts payable. Supplies balance is easy, 1,250. Equipment is easy, 10,050. Common stock, there's only one transaction, so that's the balance, Dividends, there's only one transaction, so that's the balance. In revenue, we'll add these two together and we'll get a balance of 17,700 as a credit, and then rent expense will be 1225 as a debit. The final step here is to prove that this is in balance. So what we do is we add all the assets, which includes cash of 94,350. We add, that's 350, not 356. We add 1575 for accounts payable, 1250 for supplies, and 10,050 for equipment. Altogether, this will equal 107,225. Go to the other side, we'll add liabilities, which are 0, with common stock, which is 100,750. Subtract 10,000 in dividends. Add 17,700 in revenue, and subtract expenses of 1225. When you do the math here, you get 107,225. So we're in balance, and our trial balance worked out. Anyway, I hope this helps. If you have any questions, be sure and let me know, and have a great day and a great weekend.